Good morning, ladies and gentlemen, and this week we will again start with the 10-year note because it's done something which potentially could have long-term ramifications, and that is really the subject of this video. If you remember, we've said months ago that we are stuck basically in a 270 to 3% range in the 10-year note, and indeed it has been so. We have been stuck there basically since April, but this pattern is now beginning to get mature, and certainly will be by the end of this month. It is a pattern which we didn't expect. We expected the consolidation roughly here, and then we expected that it would slowly start breaking to the upside, taking yields towards the 3.5% range towards year end as the Fed tightens the short end, and basically the 10-year keeps pace with the tightening of the short end and leaves the spread against the 2 years at roughly 20, 30, 40 basis points, something like that. Well, that looks like it won't happen, or rather there is the possibility it won't happen. This pattern now is beginning to look bearish for the long term, and that is something which we didn't expect. What could make this pattern bearish? Well, it could be the ISM, which is now falling worldwide much faster than predictions. It could be a variety of things. It could be the Fed deciding that growth is not strong enough, or that wage growth is not strong enough, or whatever, to not tighten as much as we thought they would by year end, which would cause probably a fall to around 250, 257, where we were basically at the beginning of 2017 in the first quarter. That would be very, very significant for a variety of assets, and we will look at the implications next. But what we are saying is that we are no longer so sure that the break will come to the upside. We see an equal, if not greater, chance that the break will come on the downside. If we just look at some targets, we could potentially get this kind of from 270 to 315 on the downside. So we could actually come back and test this trend line, which is around the 233 area, or maybe to call it somewhere around 244. So that would be a very significant move in a market which has seen so little movement for so long. It could be quite something, and could be something which indicates longer term problems, and we will now examine those. What is very interesting to note is that basically the spread between bunds and 10 years has been unmoved for a long time. So this is 524, so this is basically the middle of April and May. Nothing has been going on in that spread since basically May. That is very, very significant, because basically the bunds and the 10-year notes are mirroring each other's behavior, and that is slightly unusual. You would have thought in a period where there was strength in the US economy, that spread would have continued to go out, but it hasn't, and that is to us tells us that unless Germany makes a move as well, and Germany is certainly not in a position to start going up with a technical picture looking like this, it is more likely than not that the US will keep on coming down in terms of yield. So we are beginning to think of the improbable, and that is that after a period of the Bund trading around the 20 basis points to 30 basis points range, i.e. this kind of level, 17 to 20 to call it 40, it could then break down and retest actually these levels around -20, which would be a significant crisis in Europe. But we have seen that before. We have seen the divergence. Germany is beginning to be untradeable because it's just uh, a flight to safety trade from Italy and possibly Spain later on, who knows. This is what Italy looks like in the 10-year. It is now trading at 3%. You can see this huge movement out of Italy, which shows no sign of stopping, and all that's happening is that the spread between the US and Germany and Italy is going out, while Germany does absolutely nothing. It trades in a 10-point range, and that is exactly what is happening to the US. Therefore, any kind of lead from Germany will probably be mirrored by the US. It's a very interesting time. This pattern is also becoming bearish, and that is also something that we are very aware of. What we're saying is that now we are seeing an increased probability of the 10-year coming down in yield and testing levels around 240 to 250 over time, which is a significant departure from what we thought earlier in the year. And something has to cause it, and there will be many ripples and repercussions because of it. Nothing that we are saying is going to manifest itself in the next 1 week, 2 weeks, probably even 1 month or 2 months. It is a longer term trend which could be very interesting. Now, this is the DXY. As you know, we call the move up to 96.50. We're almost there. But what I want to show you is how often 96.50 was a huge support. Look at this period here in June of last year. Look at this period here, which took months to break 96.50. If you go back in time, you will see that basically 96.50 was the swing level throughout the 2015. Look how many times and how many touches there are at 96.50, both as support and then as resistance. What we're saying is that don't get overexcited in terms of getting long of dollars here. It will take a while to break this level properly, and even if it does break this level, it's more likely than not to come back and test it. We are overbought, and through the Bollinger Bands, would not be surprising to see at least a 3 to 4 week period of trading up and down around 96.50 before the dollar is able to make a break. Now, why is that significant? It's significant because it actually coincides with the chart of the 10-year that we showed you, a period of consolidation at these lower levels before it breaks down in yield and up in price in the futures, and this could be reflected in the dollar. It's going to be a quiet period, but then after that we could have absolute explosion of volatility, and we could be heading up towards 104 or even higher in the dollar index. Why would that happen? Well, there are many reasons why it could happen. One is that the market is going to tighten for the Fed, and if the market can't tighten the 10-year notes and it can't tighten the short term, it's going to tighten financial conditions via the currency. That would be the primary explanation that we can see at the moment, but there could be a variety of explanations, some coming from Europe, maybe some coming from the Far East, who knows, it's too early to tell. But this is what the technical pattern is telling us. Be careful after a long period of consolidation, probably around 96.50, that we don't get the final leg back up to retest the highs around 104. As we all know, when you throw a rock into a pond, you get many ripples, and probably the most significant ripple could be in XLF. This is a chart of XLF here in green and red, while this chart in blue is the difference between short-term rates, i.e. where banks fund themselves, and basically 5 years, which is where they lend. What are banks? Banks are just basically intermediaries converting overnight rates into 5-year rates. They borrow overnight, they borrow short, and then they lend at roughly 5 years. So what is important to a bank for its profitability? The only important thing, the most important thing, sorry, is that the overnight spread between overnights and the 5 years is steep. Basically, banks make money out of steep yield curves, and they lose money, or they make very little on the spread when the yield curve is flat. The flatter the yield curve between overnights, or 1 week or 2 weeks or 1 month, and the 5-year area, the less profitable banks are. And this spread is now going out to almost record levels. You can see how big the crocodile jaw is, and that is the biggest dangers that we can see. Now, if we go back in time, every time that this spread became unsustainable, like in '07, we had a closing of the jaws of the crocodile. This was one of the main warning times of this spread, and it's basically doing the same thing again. We're not saying we're in '07, far from it, but what we're saying is that the way the Fed rebuilt the profitability of the banking system was by having a very steep curve between overnight and 5 years, as you can see here. In 2009 to 2010, this curve was very steep, and the banks started making some money, and their share price rose. Now their share price is actually far higher than the spread, and we think at some stage it is quite likely that this spread could collapse. And therefore what we're saying is that the danger of holding XLF here is just too high, given what the reward might be. What's the reward? The reward could be a move back up to 26, possible, but unlikely while we have this kind of pattern. This is a decline of the yield curve spread, and therefore we just think it's very unlikely that this is sustainable. Why did it move up? Well, it moved up because of the Trump tax cuts and of the deregulation in the banking system, which increased profitability. So this is the explanation for it. From now on, since all that is discounted, the dangers move to the downside. Banks just cannot be profitable with this kind of curve pattern. And nobody really is discounting the possibility that bank profits are going to go for a very large fall in the next few quarters. Therefore, what we're saying, the most important ripple coming from a potential deceleration of the increase in 10-year notes is this spread. The spread between XLF and the price of overnight money to 5-year notes. This could come down quite significantly, and we could have easily a move back down to 20, which is a 10% fall plus in XLF relative to everything else. XLF is now becoming a zombie as far as we are concerned, and over the next few days and weeks we will be selling every single financial stock that we own, simply because the risk reward is just not there. This is a daily chart of XLF, and once more with the proviso that nothing we're saying is going to be reflected in the market in the very short term. We're not talking about anything that's going to happen in the next few days or even the next 2 or 3 weeks. We're talking about a longer term move that you should be aware of and you should be preparing for now. This basically is the channel that held XLF throughout, apart from its stupidity period around the end of 2018 and the beginning of this year. And this is basically your sustainable move around the 200-day moving average. It's interesting to note, isn't it, that while almost every other sector is well above the 200-day moving average, every single important sector like XLY and XLK, XLF, which is, let's face it, over 20% of the S&P, is just basically holding on for dear life to its 200-day moving average. So we have this gap that we left here, which comes in right about 2870, and then we have the resistance here just above 29. Those are very good levels to put in your offers. Get rid of all your XLF exposure, all your JP Morgans, all your who knows, Bancors, whatever you might own, simply because the risk reward just doesn't apply in this case. And this is not something, again, for the short term. This is something that we think is going to take quarters to come out. But when it does, we could be looking for XLF coming back and retesting basically these levels around 23. So just the risk reward is nowhere near attractive enough to be able to hold. If we just do a very typical retracement possibility, we're looking that 0.618 comes around 23.29, roughly at these levels. That is what we think could easily happen to XLF. What would that imply for ES? Well, it's very tough to say because you're just getting more and more rotation, and basically the market is not breaking any significant levels. If we look at what happened last week, on the weeklies, basically we tried to go near the top of the Bollinger Band. We failed. We came back down towards the opening price of the week. We broke it slightly, stopped people out, and went back, straight back towards the opening price. An indecision week, but we would not see this as significant, basically, unless we break this level, which is around the 28.10, and this moving average. We don't see that anything much has happened. We keep on making higher highs on the weeklies, lower and higher lows. This is still a bullish pattern. This is still something which is not saying that we are going to have a big move down in the overall index, and that is quite normal. We certainly don't expect this market to test anything lower than 2800, let's say, and then move back up. And at some stage we're convinced we will break these highs and go up towards 3000. Can we do that without XLF leading? Of course we can. We've done this whole move without XLF leading. XLY needs to lead, or XLK needs to be strong. At the moment, neither of them are, but that is basically what this chart of ES is saying. It's saying that we are going to have quite a bit of sideways trading before we are in a position to move higher. Looking at NQ as a leader is really at the moment, it just isn't. This is not a pattern which basically says this is going to be a leader. This is a pattern which says we're going to move sideways. At some stage I would not be surprised to see it test 7,280 or even 7,220, but those are going to be wonderful buy levels for a move that should take out the highs at some stage after the summer. We are in the doldrums of summer. This kind of pattern is not surprising. Why should we not basically do what we have been doing here? Basically a 10-day sideways move right on this shoulder, so an inverted head and shoulder, cup and handle, whatever you like to call it, and then break higher. To me, that is a completely normal summer kind of trade. As we warned last week, the one market that just can't get out of its own way is Europe. It tried the 3,500 level, we said buy puts. It basically collapsed afterwards to 3,425. What is this market doing? Well, probably not a lot. If it were to drop to levels around 3,380, we would be, or 90, we would be interested buyers of calls for a move back up to 3,500. But that is about that. We just don't see that this market is ready to do very much. And if we look at basically the chart of the DAX cash and we enlarge that, it's the same pattern. It just basically will not sustain the 200-day moving average around 12,750. But this trend line is very, very important. We want to be buyers of calls around the 12,200 to 12,250 level, because this trend line has been extremely important for years and has held the channel for years. Should we start breaking below that trend line, it's going to get very ugly potentially. So you have a very important level around the 12,200 level in the DAX to buy call spreads, looking for a move eventually up towards the 13,500 highs. What could change our mind about stability in equities? And the only thing really that could change our mind at the moment is this spread, which is a very early indicator of risk off, which is the stocks, the semiconductors over the yen. As you can see, it was the first in 2016 to give you a buy signal, and probably it'll be the first to give you a sell signal. When we start consolidating below the 200-day moving average, and this trend line, which is to us very important, is going to be the first sign that we have lost the leadership of the technology sector. Without technology, we are not going to move significantly higher, especially since we see XLF now as a potential zombie and dead money. Therefore, what this spread does, and we will naturally tweet to you, alerting you if it does something very important, is going to be key in the next few weeks, and we'll be watching it like hawks. As you know, spreads do not turn markets immediately. It takes time, but they are the most wonderful indicator of what is going to happen in the medium term. So for the biases for the deadest week of the year, as we said, while before we were worried by the upside, we're now worried by the downside. That is a very significant change. Keep it in the back of your mind. Watch yields. Germany is becoming untradeable because you're not trading Germany, you are trading basically some stupid some ridiculous budget in Italy. Who knows what the Italians are going to do? No one, probably not even them. And if the Italians come up with a ridiculous budget, you will see the spread between Italy and Germany just skyrocket, and you could be, and say you're short of bonds, you're going to be offside 100 basis points for no reason whatsoever, while nothing happened in Germany. The only way to trade Germany is basically through options. I would not touch the bonds anymore in an outright, simply because there's no point. You just do not know what kind of stupidity the Italians are capable of. XBX, we still can't see significant strength beyond 28.30 because we think the US dollar will remain strong. But there is absolutely no reason to do anything but buy the dip around the 28.10 area. 28.10 to 2800 is basically the area to buy, and anything much above the 28.30 you're talking about 28, 60, 70, because it's not going to make new highs in the short term. You just sell and stay away. The least favored option we have is to sell this into a hole, like on Friday. You know, selling 28.35 to selling 28.30 to us is just stupid, because we know the market is strong. It just absorbs the selling and then slowly ratchets higher, fills the gap, and then does something else stupid. So it's just not the kind of market you want to be involved. You don't want to be involved in SPX. NQ, we just don't see it. There is no leadership there. Why put your money at higher risk, which NQ has the higher volatility and therefore the higher risk? No, we would rather have it in some boring sector of the S&P, not XLF. Now, XLF here, I would definitely put out offers at the levels that I showed you in that video and hope you get filled and you just leave behind, just sell everything you have which is financial, because the risk reward is so bad. You could make 1 but lose 10. It's just not worth sticking around. Volatility, we have not looked at it because there's nothing happening there. The volatility is compressed. There is nothing to do in volatility, and that reinforces the argument for SPX. We showed you what we think of European equities. We're still waiting for a clear buy signal to buy EEM, and back to the dollar, 96.50. But it's going to take weeks and weeks and weeks of trading. Stick with the options. They are cheap and they're a much better risk reward. You won't get whipped nearly as much with the options as you will with the outrights. Thank you very much indeed, and tweet to you on Monday.